Barwell there with the sport. It's 5:36. This is Wake Up to Money with Sam Washington and Mickey Clark. Now, for much of the past decade, India was celebrated as an economic success story. Even when the financial crisis struck in 2008, the country appeared to weather the storm relatively well, fueling hopes that emerging markets like India could help drive global economic recovery.
Well, all that has changed this year. Stuttering economic growth and an increasing reliance on cheap foreign money has sparked fears of a full-blown financial crisis, and investors have taken fright. The value of the Indian currency, the rupee, has fallen by around 15% against the US dollar over the past few months.
So what's going on in India? Is just a short-term blip, or are we seeing the first stages of a full-blown crisis? Let's ask Bundeep Singh Rangar now, chairman and founder of IndusView, advisors to multinationals on how to do business in India. Morning, Bundeep.
Good morning, Vicky.
What's the fundamental problem with India now? Because this seems to have unravelled quite quickly, doesn't it?
Well, the thing is, India's always had a current account deficit, which is the addition of investment flows to just trade, import and export figures. Now, in the past, India has relied on a huge amount of capital inflows as an attractive economy pulled in foreign investors. It's kind of like a company having its biggest customer and today losing it. So when those capital inflows ebb, because all of a sudden India is not as attractive, the GDP growth is slower, you've had political uncertainty, things like retroactive potential taxation on the Vodafone case. Not to mention that the quantitative easing program in the United States is changing, so all of a sudden those cheap dollars may not be around anymore.
Is it the quantitative easing that's actually sparked all this?
Well, to some extent, that sparked that across Asia. It's not just India. Indonesia is another example where that's having an impact. But India has some more fundamental structural issues where it's just been compounded. So the dollar availability is now causing a rupee decline.
But Bundeep, let me ask you, how much of this is about fundamental macro issues with India, and how much of it is what sort of city folk would call the unwind of the carry trade, so just hedge funds moving money away from India and the rupee and back towards Western economies where yields are getting stronger?
Yeah, no, I understand the carry trade part, and that's obviously where Japan's played a big role in terms of cheap currencies. It's not the case in India, because India was expecting to be a double-digit growth economy, and today it's about half. That's about 5%. When you weigh that against inflation, which is not far from 5%, 5.79%, real growth may actually be zero or negative. So there's more fundamental structural issues here. On top of that, India's had political uncertainty. With an election coming up next year, there's not a lot of bold steps being taken by the government to give investors confidence. So what's happened instead is the judiciary stepped in. Whenever you have the judiciary stepping in to make legislative decisions, that is not a recipe for confidence for investors. Last but not least, bureaucracy. So when you have major infrastructure projects, such as you take coal, for an example. India is one of the biggest reserves of coal in the world, but it imports $8 billion worth of coal each year. Why? Because the environmental clearances don't come in time. Major investments from foreign companies get stalled. People get shy and walk away. The same is true in telecoms. The same is true in national highway infrastructure projects. So it's a compound effect of bureaucracy delaying things, GDP growth slowing down, and just a lack of political will being translated into investors being drawn into their economy.
Now, you advise businesses, don't you, on going into India? Surely this must make it cheaper for people who have Indian sort of call centres or, banks who have a large part of their operations in India. Makes that cheaper and more attractive, doesn't it?
Yeah, it does. There's a silver lining in this, which is that Indian costs go down relative to what it was in the past in certain other parts of the world. For IT companies, which of course are a mainstay of India's growth, it's great because their costs are down and the exports suddenly become cheaper. However, the Western economies aren't growing as much. It's questionable how much that competitive actually translates.
What's the impact on a country such as the UK, which does have trading links? We've seen with Tata Steel and the likes, those sort of cross-holdings. Is there any impact on the UK economy from this?
Well, the one thing that does happen is that for mergers and acquisitions, Indian assets are now 16% cheaper than they were at the beginning of this year. So if you want to buy into Indian companies or invest in companies, it's a hell of a lot cheaper than it was just 8-9 months ago. So there is a direct impact. So it's not the Tata coming and buying into Jaguar Land Rover. It's probably the other way around, where investment into India becomes cheaper. The other part I might add is that remittances are huge. So India's got a $70 billion a year inward flow of personal expat transfers of money. That's up almost 1.5 times.
Because people are getting more rupees for their money.
Absolutely. So if with every 1% decline versus the dollar, 1.5 times more goes into India. So now it's about 25% more than the 70 billion that went in last year. And that also can help the current account deficit.
But what about corporate debt? because you've seen a big drop in the rupee, the value of the rupee. How does that impact on PLCs in India with regards vis-a-vis debt?
That's a fantastic question, because India gets about $40 billion worth of debt financing overseas. Most of it's in dollar denomination. It's called a foreign currency convertible bond under a larger remit called external commercial borrowings, which is exactly what it sounds like. Those will definitely get impacted because Indian companies' ability to get cheaper debt is no longer there because in rupee priced versus the dollar. And of course, servicing the debt becomes much more expensive. So it is a costlier exercise today.
Bundeep, you talk about the fundamental economic problems of India. How bad is it? I mean, are we looking at an IMF situation again?
No, I mean, even though compared with 91, India has arguably a greater decline in the rupee versus the dollar, it's not as bad as a decline then. And India does not have today the 5 days away it was from losing its foreign currency reserves.
The GDP has gone down, hasn't it?
GDP has gone down, and India has about at least 6 months' worth of foreign currency reserves. And I do believe that there is a astute management on top there. The finance minister, the prime minister, all well-tuned economists, and there's a new Reserve Bank of India governor. I think they just have to make bold steps and not worry about the political price they might pay at next year's elections, because that's the right thing to do for the country.
I mean, the emphasis you've made so far is that India's economy's got all its eggs in one basket. What can the government do? What can politicians do to spread that?
So one of the key things that India has is, again, this expat 25 million population, which sends a lot of money into India. And that's unlike a lot of the emerging economies elsewhere. Indonesia, for example, does not have that. The more they can tap into foreign third-generation Indians sending money into India, they're now doing that. For example, you have this thing called an NRE account, which is a non-resident account to get high interest rates on foreign currency deposits in India. They've suddenly increased the interest rate available for foreign nationals of Indian origin to deposit money into India. So that's one way of offsetting this capital inflow. The big one, of course, is getting large institutional investors and fund managers via foreign institutional investment or foreign direct investment. And that's going to take a very clear-cut statement from the government that says a project, for example, like coal or highways, should be approved like China does within 90 days. One way or the other, give us an answer. Don't keep things hanging on, because investors lose confidence. And if they can just say we work on 90-day policies, just like corporate India does in many ways, you can expect some certainty, binary even if it is, but at least you get some outcome. Lastly, of course, you've got tuning down of certain import items. So India gets 80% of its oil from overseas. Oil price is stable, but gold is a big one. So biggest importers of gold in the world, about 800 million tons. At $50 million a ton today, that's $40 billion worth of gold. So they can rein that in, perhaps.
Fascinating stuff. Many thanks for joining us this morning. Bundeep Singh Rangar there, chairman and founder of IndusView.